Welcome to Plato's Cave for our December 18, 2014 broadcast. My name is Doris Motormouth and I am your Poseidon news anchor. UBS turns to artificial intelligence to advise clients. Bloomberg. UBS Group AG, UBSG, facing the threat of competition from Google Incorporated, GOOGL, and Amazon.com Incorporated, has turned to a Singapore-based technology company that uses artificial intelligence for help delivering personalized advice to the bank's wealthy clients. Scream Technologies Pte. Limited beat some 80 teams competing in the Innovation Challenge, a contest organized by Switzerland's biggest bank that offered 40,000 Singapore dollars, $30,000, and a potential contract to the winner. Their task: extract the information most relevant to an individual client from an explosion of data and deliver this tailored content to clients' mobile phones, iPads and other digital devices. Banking is one of the most rudimentary industries when it comes to digitalization, Dirk Clay, Chief Operating Officer for UBS Wealth Management and responsible for digital initiatives, said in an interview. eBay, Amazon, everything is getting more and more digital. The question is how we translate this into a similar experience for our clients. Big global banks like UBS are turning to technology to mine data for insight on its customers that could help lenders stay competitive in the digital era. The introduction of mobile payment systems offered by internet giants like Google Incorporated, Goog, and Apple Incorporated has alerted traditional banks to the potential threat from tech companies with vast databases and the know-how to exploit them. Information overload. We have the data. Too much of it. UBS, the world's biggest wealth manager, said in a web posting announcing the competition in September. Across the industry, clients are overwhelmed by data. More than 70% of financial institutions in North America believe that big data analytics, as this field of engineering is known, offers them a significant advantage over their competition, Capgemini said in a 2014 report. More than 90% believe that successful big data initiatives will determine the winners of the future, the consultancy said. 5 finalists vied to win over a panel of judges at the bank's offices in Singapore on November 28. Clay said the bank chose Asia as the venue because, in addition to being a hub for wealth management, clients in the region are more likely to use mobile phones and other digital devices to interact with the bank. Privacy concerns. Scream was founded 7 years ago by Chief Executive Officer Ian Chapman Banks, a technologist for 20 years, and Renee Race, a Columbia University graduate who says he spent 15 years on Wall Street developing algorithms for trading derivatives, including at Merrill Lynch and Company. The company, which employs 15, counts Visa Incorporated, V, and DBS Group Holdings Limited among its customers. In a YouTube video presentation, the founders show how they deploy a cloud-based computing engine driven by artificial intelligence to crawl through a wide range of openly available, unstructured data to find all possible combinations of the likes, interests and affinities of Singapore's 6 million odd people, based on a list of 130,000 things that people do every day. Unstructured means the data has to be understood from its content, not as a result of it being organized in a database. Behavior patterns. We have identified over 85 million individual behavioral patterns that are engaged in by the people in Singapore, Scream says in its video. This includes everything from food, vanity and travel preferences to deeper, more personal questions such as their aspirations and outlook on life. Fine-tuned for financial services, the technology allows Scream, which stands for Sequential Quantum Reduction and Extraction Model, to build a profile of an individual showing potential matchups with different types of wealth management products. In response to questions about privacy concerns, Scream said it designed the system to be fully anonymous. UBS would use Scream to match results with its own data on clients. So at no point in time are we involved in identifying individual clients, the company said when contacted by Bloomberg News. UBS has clear and strict data security standards and policies that are regularly reviewed, the bank said. Data security and confidentiality have high priority at UBS. Other banks are also spending on data analytics. Goldman Sachs Group Incorporated, GS, in November led an investment of $15 million in Kensho Technologies Incorporated, an analytics platform that can automatically answer complex financial questions posed in plain English, according to its website. Goldman Sachs plans to use Kensho's technology across the firm. Limitless opportunities. Internet firms are throwing down the gauntlet to the banking world. Researchers at Deutsche Bank AG, DBK, said in a November 11 note written by Tom Dapp. From mobile payments and simple financing right through to elaborate big data solutions, a number of technology-driven firms are challenging the established banks and offering their relatively loyal customers attractive financial products and services. Credit Suisse Group AG, CSGN, UBS's smaller Swiss competitor, is expanding services to include a digital platform for its private bank clients that will also leverage big data, starting in Asia. UBS plans to roll out a digital service in Asia next April that will let clients access any market relevant to their investments. The bank, which said it has spent hundreds of millions of dollars on digital technology, plans to charge for some new features. Finance will always be a highly relational industry, but technology can definitely help make those relationships more meaningful and better informed, Cesare Alavina, representing the runner-up, Zurich-based Squiro, said by email from Singapore. Exxon Mobil shows why U.S. oil output rises as prices plunge. Bloomberg, crude oil production from U.S. wells is poised to approach a 42-year record next year as drillers ignore the recent decline in price, pointing them in the opposite direction. U.S. energy producers plan to pump more crude in 2015 as declining equipment costs and enhanced drilling techniques more than offset the collapse in oil markets, said Troy Eckert, whose Eckert Global LLC owns stakes in more than 260 North Dakota shale wells. Oil companies, while trimming 2015 budgets to cope with the lowest crude prices in 5 years, are also shifting their focus to their most prolific, lowest-cost fields, which means extracting more oil with fewer drilling rigs, said Goldman Sachs Group Incorporated. Global giant Exxon Mobil Corporation, XOM, the largest U.S. energy company, will increase oil production next year by the biggest margin since 2010. So far, the Organization of Petroleum Exporting Countries' month-old bet that American drillers would be crushed by cratering prices has been a bust. Oil prices. Companies that are already producing oil will continue to operate those wells because the cost of drilling them is already sunk into the ground, said Timothy Rudderau, who manages $1.5 billion as Chief Investment Officer at Mount Lucas Management Corporation in Newtown, Pennsylvania. But I wouldn't want to have to be making long-term production decisions with this kind of volatility. Crude oil production from U.S. wells is poised to approach a 42-year record next year as drillers ignore the recent decline in price, pointing them in the opposite direction. A U.S. crude bonanza that has handed consumers the cheapest gasoline since 2009 has left oil exporters like Russia and Venezuela flirting with the economic chaos. The ruble sank as much as 19% on December 16 to a record low of $80 per dollar before recovering to close at 68. Russian bond and equity markets also crumbled. In Venezuela, the oil rout is spurring concern. The country is running out of dollars needed to pay debt, and swaps traders are almost certain default is imminent. Profitable wells. U.S. oil production is set to reach 9.42 million barrels a day in May, which would be the highest monthly average since November 1972, according to the Energy Department's statistical arm. Output from shale formations, deep water fields, the Alaskan wilderness and land-based wells in pockets of Oklahoma and Pennsylvania that have been trickling out crude for decades already have pushed demand for imported oil to the lowest since at least 1995, according to data compiled by Bloomberg. Existing wells remain profitable even as benchmark crude futures hover near the $55 a barrel mark because operating costs going forward are usually $25 or less. Tom Petrie, chairman of Petrie Partners Incorporated, said in a December 15 interview on the Bloomberg surveillance television program, shut-ins. That's why prices that have tumbled 47% from this year's peak on June 20 haven't prompted any American oil producers to shut down wells, said Petrie, a U.S. military academy at West Point graduate who has advised Saudi Arabia, Alaska and the U.S. government on energy issues. The average cost to operate an existing well in most parts of the U.S. is about $20 a barrel, Petrie said. It might be $5 higher or it might be $5 lower. That's the out-of-pocket costs that we're talking about. Until you dip into that and start losing money on a cash basis day in, day out, you don't think about shutting in wells. Benchmark U.S. crude futures dropped 4.2% to $54.11 today in New York Mercantile Exchange trading, the lowest closing price since May 2009. The futures are on track for their fourth straight weekly decline. Once oil companies sink cash into drilling wells, lining them with steel pipes and concrete, blasting the surrounding rocks into rubble with hydraulic fracturing, and linking them to pipeline systems. They have no incentive to scale back production, said Andrew Cosgrove, an analyst at Bloomberg Intelligence in Princeton, New Jersey. Sunk costs. Those investments, which represent sunk costs, are no longer a drain on cash flow, Cosgrove said. Instead, they generate capital companies use to repay debt, fund additional drilling, pay out dividends and buy back shares, he said. Exxon, the world's biggest oil producer by market value, is expected to boost crude and natural gas output by 2.8% next year to the equivalent of 4.1 million barrels a day, based on the average of 8 analyst estimates compiled by Bloomberg. That would arrest a 2-year production slide for the Irving, Texas-based company, which is spending about $110 million a day this year on everything from rig leases to offshore platforms to refinery repairs. Chairman and CEO Rex Tillerson pledged in March to raise output by an annual average of 2% to 3% during the 2015 to 2017 period. Cheapest oil at the same time, Tillerson said capital spending would drop below $37 billion in each of those years, partly because mammoth investments like the Keyral oil sands development in Western Canada and the Gorgon liquefied natural gas project on Australia's Indian Ocean coast will no longer be absorbing cash. In the U.S., Exxon spent an average of $12.72 to extract a barrel of oil last year, its cheapest operating region aside from Asia and Europe, company figures showed. Some operators have even lower costs. Continental Resources Incorporated, CLR, spends about 99 cents to pump each barrel from its 1.8 billion barrel discovery known as the South Central Oklahoma Oil Province, or SCOOP. Continental, controlled by Oklahoma billionaire wildcatter Harold Hamm, discovered the SCOOP in 2012. Laredo Petroleum Incorporated, an explorer of Texas's Permian Basin that has more than tripled production since 2010, said this month it will slash capital spending by about 50% next year. The company still sees 2015 output expanding by 12%. Shares in the Tulsa, Oklahoma-based company jumped as much as 15% after December 16 announcement. As oil explorers retrench in response to the market's decline, they will drill more selectively, Eckert said. Seismic surveys will be more closely scrutinized to ensure the best chances of striking crude and only the most promising opportunities will be greenlighted, he said. We're only going to see the very best wells drilled over the next 12 to 18 months, Eckert said. It's going to be exciting. Bernanke backs Pimco forecast for economic acceleration. Bloomberg, Pacific Investment Management Company is diverging with its co-founder and former Chief Investment Officer Bill Gross on whether falling oil prices will delay the Federal Reserve's move to raise interest rates. In its outlook for 2015, Pimco projects global growth accelerating in a rising tide, with lower oil prices helping economies, and the Fed on track to boost borrowing costs. Gross, who used to run Pimco's biggest fund before his surprise exit September 26 to join Janus Capital Group Incorporated, said the U.S. central bank may be constrained by disinflationary pressures after oil prices plunged in recent weeks. Added to this mix is former Fed Chairman Ben Bernanke, who endorsed Pimco's views when he was invited to speak at the firm's internal forecasting session. Bernanke suggested policymakers would look past the drop in headline inflation in the U.S. next year, focusing on momentum in real growth and core inflation's impact on future monetary policy, Saumil Peric, a managing director who leads Pimco's quarterly cyclical forum, and Group Chief Investment Officer Daniel Iverson said in a report posted on the firm's website today, affirming Pimco Dr. Bernanke affirmed Pimco's view that the outlook for the U.S. economy in 2015 is incrementally positive, Peric and Iverson wrote. Despite the drop in oil prices today likely leading to negative headline inflation in early 2015, we expect the Fed will remain on course to raise official policy interest rates in mid-2015, sometime between June and September, Pimco. The Newport Beach, California-based manager of the world's largest bond mutual fund, said expansion will climb to about 2.75% from about 2.5% this year. Economists expect worldwide growth of 2.8% in 2015, the average forecast in a Bloomberg survey. Growth in the world's largest economy will reach 2.75 to 3.25% in 2015, up from 2.4% in the 12 months through the third quarter of this year, as households' finances and confidence improve, Peric and Iverson said in the report. Economists predict 3% growth for the U.S. in 2015 for the full year, according to the average of 94 responses in a Bloomberg survey. Dovish stance from his new seat at Janus. Gross predicts the Fed has to take lower oil prices into consideration. I think that yes, it moves towards a dovish stance relative to what the market expected a few days ago, he said in a December 12 Bloomberg surveillance interview with Tom Keene. Benchmark U.S. oil prices have fallen below $60 a barrel, extending losses today toward the lowest level in 5 years on concern a supply glut will worsen. Gross said with inflation showing no signs of approaching the Fed's 2% target, and when the U.S. itself is, not deflating but disinflating, policymakers won't be in a hurry to raise interest rates. The $163 billion Pimco Total Return Fund, PTTRX, is the biggest bond mutual fund. Gross managed the fund until his exit, when Scott Mather, Mark Kiesel and Mihiwara took over. Barclays asks judge to throw out New York dark pool suit. Bloomberg. Barclays plc, Barc, asked a judge to throw out New York Attorney General Eric Schneedeman's suit accusing the bank of bilking its own customers to expand its dark pool, saying the state hasn't shown that clients have been harmed. Schneedeman sued Barclays in New York State Supreme Court in Manhattan in June, accusing it of lying to customers and hiding the role of high-frequency traders. The bank in July filed papers asking the court to dismiss the case and made its arguments today. Jeffrey T. Scott, a lawyer with Sullivan and Cromwell LLP representing the bank, told Justice Shirley Werner Cornreich that the state's 1921 Martin Act anti-fraud statute requires the Attorney General's office to identify specific investors who were damaged by the alleged activity and the state hasn't complied. I don't know what clients they are talking about, Scott said. They haven't identified anybody. New York has sought a leading role in reforming equities trading in the $23 trillion U.S. stock market, partly by examining where the dark pools, private stock markets usually operated inside large banks, give unfair advantages to high-frequency traders. Unlike exchanges such as the New York Stock Exchange, dark pools keep the supply and demand private until after a trade is executed. While that can help investors get better prices by masking their strategies, the opaqueness fuels suspicion that dark pools owners don't treat some customers fairly. Cornreich said she found the suit hard to follow and questioned why no individual victims were identified, pointing out that the complaint cites trade journals and newspapers. It's hard for me to believe that a very sophisticated investor would base his choice of investment platform on a newspaper article, Cornreich said. Assistant Attorney General Chad Johnson called the suit a classic Martin Act case. He told Cornreich the statute covers activity that can affect any securities transaction, whether it actually takes place or not, and doesn't require the state to show that specific investors were harmed. The point of the Martin Act is to enforce the laws of New York, which broadly prohibit any scheme, any device, any transaction which can have an effect on securities transactions, Johnson said. False documents in the Barclays case, he said. You've got false documents, misrepresentations, the failure of the broker-dealer to act on the part of their clients and impact on the securities transactions that it was handling on the behalf of their clients. The judge also noted that a similar lawsuit has been brought in federal court by Barclays investors, including large institutions and sophisticated individuals, over claims that the bank hid the role of high-frequency traders in the dark pool. Elliot Stein, an analyst with Bloomberg Intelligence, said the hearing practically flipped the burden of proof to the Attorney General's office. The judge appears inclined to dismiss the suit and may do so early next year, possibly with a chance for Schneedeman to refile it with more specific allegations, said Stein, who is a lawyer. A panel of federal judges ruled this week that the 5 cases against London-based Barclays will be consolidated before a federal judge in New York to make pre-trial information exchanges quicker and less costly. Johnson said his office often brings cases with parallel private actions, like those in federal court, and that the plaintiffs in those suits will face hurdles that won't be an issue in Schneedeman's. The judge said she will rule later on the bank's motion to dismiss the suit. The case is New York v. Barclays Capital Incorporated, 451,391/2014. New York State Supreme Court, New York County, Manhattan.